Welcome. Today we'll be talking about the process, threats, and controls of approving supplier invoices and cash disbursements, the final two activities of the expenditure cycle. Let's go over the process. First, a vendor sends an invoice to accounts payable where it is matched with its corresponding purchase order and receiving report. If the documents match, the invoice is approved, and the payment is made, and funds are transferred to the vendor. In addition, the proper updates are made to accounts payable. If documents do not match, the differences are identified and resolved. Now, it's important to note that companies can choose to pay each invoice individually, or they can pay several invoices in a set period of time, like at the end of each month. Now we'll go over the threats to these two activities. With supplier invoices, there could be errors in supplier invoices as well as mistakes in posting to accounts payable. For cash disbursements, there could be a failure to take advantage of discounts through prompt payment, paying for items not received, duplicate payments, theft of cash, and cash flow problems. Let's start with the errors in supplier invoices. When an invoice is received, but it doesn't match the price or quantity quoted, you can verify the invoice against the receiving report and the purchase order. And if need be, a phone call can be made to the vendor. You can also use Evaluated Receipt Settlement, or ERS, to pay for items purchased. This is an invoiceless approach to purchasing. This is achieved by taking the amount received, multiplying that by the negotiated price on the master file, and getting the amount due, thus eliminating the need for invoices. If you use an ERS, you'll need to restrict access to master data, so unauthorized employees can't alter vendor information. Now, for mistakes in posting to accounts payable, you can use data entry controls, so only proper and correct data can be entered into the system. You can also reconcile accounts payable records with the general ledger control account to make sure everything matches. Now we'll move over to cash disbursement threats. And we'll start with the failure to take advantage of discounts for prompt payment. Remember 2% 10 net 30 from your accounting class? This means you can take a 2% discount on your payment if you pay early. You can make sure you pay on time by filing your invoices by due date so you know when invoices should be paid. You can also use a cash flow budget to ensure you have cash on hand to pay early. Now, for paying for items not received, you could receive a made-up invoice but not notice it and end up paying for it even though items were not received. To avoid this, you should see if a supporting purchase order and receiving report are there, as well as having both receiving and inventory control acknowledge the validity of the invoice. Now, for services, make sure you use a service budget so you don't pay for services not received. So let's say you receive an order and you pay for it, but later forget and send a second payment. We obviously want to avoid this, so we can require a corresponding purchase order and receiving report for all payments, as well as enacting a policy to only pay for original copies of supplier invoices, and then canceling all three supporting documents when payments are made. So you can require supporting documents of payment, pay only original invoices, and cancel supporting documents after a payment is made. Now for cash flow problems. You may have more bills due than money on hand to pay those bills. With the use of a cash flow budget, you can manage your flow of cash so you have money to pay expenses. And finally, there's the theft of cash. This can happen in several ways. Someone could add a fake supplier to your master file, they could steal blank checks, or could have unauthorized access to your electronic funds transfer. You can avoid this by restricting access to payment methods and separating check writing from accounts payable, requiring 2 signatures for checks greater than a specific amount, And having someone independent of cash disbursements procedures regularly reconcile bank accounts and recorded amounts. So you can restrict access to master files, blank checks, and EFT terminals, separate writing checks and accounts payable duties, require dual signatures on certain checks, and do independent bank reconciliations. Well, that's it for the expenditure cycle. We'll see you next time when we talk about production.